When I was younger, investing used to feel like this private party that I wasn't invited to, like it was something that only people with loads of money did. Investing really can feel like a complicated subject, especially if it's not something you've been exposed to before. It can feel too overwhelming, and those feelings can lead to a fear of investing. And that's one of the worst things that can happen, because investing is such a vital element to getting ahead financially. So in this video, we'll talk through some basics that helped me demystify investing and help anyone who doesn't have any detailed financial knowledge or background, no matter how much you earn, feel confident to start investing. Let's get the disclaimers out of the way. I'm not a financial advisor. Nothing in this video is intended to be financial advice for you. What I hope this video will do is spark an appreciation and curiosity in the power of investing, so that you can go and do your own research and begin your own investment journey. Now, let's start with the basics of investing, which we'll go through by covering beginner type questions. Put simply, investing is getting the money that you've already made work hard for you to make even more money. There are so many different ways of investing. You could invest in starting a business, or invest in your education and knowledge, or stocks and shares, which we'll focus on today, or investing in collectibles like art or vintage cars or wine. You could invest in crypto, in real estate, in bonds, or forex trading. That's not even the full list, but it makes the point. There are so many options out there. The point is, you want to be able to put in a certain amount of money and get even more money out of your investment after some time. It's important to invest in order to beat inflation and grow wealth over time. Investing helps you achieve financial goals beyond what traditional savings can offer. A Big Mac cost 45 cents in 1967. In 2024, the cost is $5.15. Now, while that's only a difference of $4.70, what that means is if you had $5.15 in 1967, you could have bought 11 Big Macs and still had some change left over. And when we apply that principle to more expensive things like houses, it makes the astounding impact of inflation even more apparent. At the start of the 1960s, the average house price in the UK was £2,189. And currently it's £281,000. That's staggering. Inflation is such a wealth killer and is silently robbing us over time. And we need to invest to not just keep up with inflation, but hopefully beat it over time. Most savings account interest rates fail to keep up with, let alone beat inflation. You can earn returns from investments through different avenues. It could be dividends, which is when a company pays out some of its profits to its shareholders, or interest payments, or by an appreciation in value of what you've invested in, which is unlocked by selling that investment for more than you paid for it. That's also called capital gains or capital appreciation. The type of return you get depends on the type of investment you've made. For example, bonds typically pay regular interest. Some investments give you more than one type of return, like stocks that can pay dividends and also increase in value, and real estate, which you can earn rental income from and which can also appreciate in value over time. The main things that make an investment beginner-friendly are simplicity, affordability, and the reduced need for extensive financial knowledge and active management. Now, we're going to apply this to what I think is the most beginner-friendly way to start investing, which is through index funds and exchange-traded funds, or ETFs for short. In order to explain what index funds and ETFs are, let's start by going through a few basic concepts. Firstly, let's talk about stocks and shares. Owning a stock is basically like owning a piece of a company. And a stock market is a virtual store where people buy and sell pieces of companies. Next, let's talk about bonds. Think of a bond like a loan that you give to a company or a government. In return, they promise to pay you back the original amount after a certain period plus interest. Next, let's explain commodities. A commodity is something that you can buy and sell. That's usually a basic good used in commerce. Think of things like oil or gold or wheat. Imagine you're shopping, but instead of picking out individual groceries, you grab a pre-filled shopping cart that represents a little bit of everything that's in the store. That's kind of like how index funds and ETFs work. These funds are collections of different investments like stocks, bonds, or commodities grouped together to track certain sections of the market, known as indexes. When you buy into an index fund or ETF, you're buying a slice of this big mixed bag, which helps spread out your risk across a variety of assets. It's like diversifying your shopping cart with a variety of goods rather than just filling it with one product. The key difference between index funds and ETFs lies in how you can trade them. ETFs allow you to buy and sell throughout the day, giving you more flexibility, just like stocks. On the other hand, index funds' buying and selling prices are set at the day's end. I won't worry about this distinction in this video because it doesn't make much of a difference for everyday investors who are intending on holding their investments long term. For the everyday investor, it's worth noting that ETFs usually require lower initial investments and can be more tax efficient. One of the most popular indexes to track or mimic is the S&P 500 index. The S&P 500 is a stock market index that tracks the performance of the 500 largest companies listed on the stock exchanges in the United States. If you buy an index fund or ETF that mimics the S&P 500, you're kind of buying a piece of each of those 500 companies. That includes companies like Microsoft, Apple, Amazon, Tesla, Alphabet, to name a few. So let's see how index funds and ETFs stack against the principles I mentioned earlier about what makes investments beginner friendly. I'll just refer to ETFs for the rest of the video, but just keep in mind that the principles are basically the same. Firstly, when it comes to simplicity, investing in ETFs is like using a pre-made cake mix instead of baking a cake from scratch. With ETFs, you don't need to figure out which stocks or bonds to buy individually. If we could all go back to 1997, I'm sure most of us would all go and buy a bunch of Amazon stock, as much as we could afford, right? Because we would know that we're going to get rich off of that if we hold on to that stock. The obvious problem is we can't go back in time and make that same huge fortune. There is no crystal ball telling you which stock you can buy now that will explode in the future. We make investing decisions using past and present knowledge only as a guide. Buying individual stocks is quite risky because you're exposed to huge potential losses if the company underperforms. The beauty of ETFs is that it's a one-stop shop solution where you can buy a share of the fund and automatically you own a little bit of a lot of different investments. It takes away you having to decide which company to invest in. Generally, while individual stocks may plummet and you could risk losing all your money, if you're invested in the top 500 companies in the US, you'd expect that while some company stocks might lose value, the increase in value from the other companies will be enough to offset this and lead to overall growth of your investment. Secondly, affordability. Imagine if you could join a gym and use any equipment or attend any class at a really low price without having to pay extra for each machine or class that you try. That's what ETFs offer. They often come with lower fees than trying to do it all on your own and having to buy stocks individually. Besides, a share in Amazon currently costs more than £170, which means you need at least that much to get started in investing if you were investing directly. But thanks to all the different investing platforms out there nowadays, you can literally start with investing with as little as £25 a month and even less from other more budget-friendly options. Platforms like Trading 212, eToro, Free Trade, and Vanguard in the UK, just to name a few, are platforms with really budget-friendly options to get started. The third aspect making ETFs beginner-friendly is the reduced need for a lot of financial knowledge and active management. With ETFs, you don't need to be a stock market expert or spend your days watching the market or researching individual stocks you might want to invest in by analyzing balance sheets and cash flow statements and profit and loss accounts. ETFs take care of the heavy lifting for you. Going back to our gym analogy, it's like having a workout plan that adjusts automatically through your fitness journey without you having to always research every exercise ever invented. Linking back to the S&P 500, these top 500 companies are in different sectors. It's very heavily technology based, but the other sectors represented in this fund are healthcare, real estate, telecommunications, energy, just to name a few. You get to invest in all these different industries just from investing in one fund. Also, once you've invested your money, you can just leave it and not have to think about it, except for the occasional checking in just to see how your investments are doing. This is quite a passive form of investing, which is really, really great for beginners. You don't actively need to do anything once you've invested. Now let's talk about how you can buy an ETF. To invest in ETFs, you typically need a brokerage account. A brokerage account is like a special wallet for buying and selling things like stocks and bonds. Just like you need a bank account to save or pay bills, you need a brokerage account to invest in the stock market. You put money into this account and then you can use it to buy investments the same way you would with online shopping. What's great is there are so many different options of brokerage accounts to choose from. I personally use Vanguard due to its popularity for low cost and just overall reliable reputation, and Hargreaves Lansdown because of their wide range of investment options and educational resources. Next, let's talk about some basic principles of investing and what to look for. The first principle or thing to look out for is investing in the most tax efficient way possible. This means investing in a way that minimizes the amount of tax that you'll have to pay as much as possible on any gains that you make. It's all well and good to make a lot of money on your investments, but besides inflation, the other cost that can really eat away at the gains you've made is tax. So you'd want to find a way of legally reducing that tax liability on any money that you make as much as possible, which would mean you get to keep more of the money that you've made. Now, this varies depending on which country you live in and you're investing in. In the UK, for example, one of the best ways to be tax efficient with index fund or ETF investing is investing via an ISA, which stands for Individual Savings Account. ISAs allow you to not pay any tax on interest, dividends, capital gains earned on any amounts invested within the ISA wrapper. The amount that you can invest tax-free in any given tax year at the moment is capped at £20,000 a year. The second important principle is diversification. We're all familiar with the saying, don't put all your eggs in one basket, which is basically a cautionary tale about risk diversification. Now, risk and investing go hand in hand. There's no such thing as risk-free investing. There's always an element of risk. Not just that you might not make any money, but that you might lose some, or in extreme cases, all of the capital you've invested as well. Risk shouldn't make us fear investing. Rather, we need to find ways to manage that risk. Think of all the different choices you could make with your money if you decided not to invest out of fear. There's no such thing as a risk-free option with your money, even if other options feel like they involve no risk. And the biggest risk to note is the opportunity cost of missing out on potential earnings from investments that could grow your money more effectively over time. The third principle you'd want to think about is more risk, more reward. In investing, the idea of thinking about more risk, more reward is a handy way of thinking about where to put your money. Let's put it this way. If you go with something like investing in bonds, you're looking at a pretty safe investment, but the returns are usually modest. Now, if you switch to stocks, there's more volatility, making them riskier. However, they also offer the chance of much higher returns if the companies do well. ETFs can be a bit of both worlds. They might include a bunch of stocks offering potentially higher returns than bonds, but with the diversification across many stocks, they spread out the risk more than just investing in a few individual stocks. And even riskier investments like crypto are often attractive to people because of the potential of making really huge returns. So your choice really boils down to how much risk you're comfortably taking on for the possibility of higher returns. The fourth principle is broker choice. Choosing the right broker to invest through is a crucial decision that can significantly affect your investment experience and outcomes. There are a few key factors to consider when choosing a broker. Firstly, low fees. Look into the broker's fee structure carefully. This includes commissions on trades, any account maintenance fees, and other charges that could eat into your returns. Some brokers offer commission-free trading, which can be particularly appealing for frequent traders. Secondly, consider the broker reputation. You want a broker that is reliable and trustworthy. Check reviews and ratings on financial websites, and consider things like how long that broker has been in business. Regulatory compliance and protection offered by financial compensation schemes are also important to note. Thirdly, consider their options of products. Depending on your investment strategy, you may want a broker that gives you a wide range of investment options, such as stocks or bonds, mutual funds, ETFs, and possibly even more. Another important point to consider is the educational resources that broker offers. This is especially important for beginners, and educational resources such as tutorials or videos, webinars, and articles that the broker offers can help you become more knowledgeable and confident in your investing. Some brokers offer better educational resources than others, so do your research if that point matters to you. Another important principle of investing is what affects a stock's value. It's kind of like a roller coaster, impacted by a bunch of different factors. First up, there's the overall economy. When it's booming, investments generally do well. Interest rates also play a big part. Lower interest rates generally boost stock prices. Then there's the company's performance itself. Strong earnings reports can send prices soaring, while a drop in profits might do the opposite. And let's not forget market sentiment. Basically, how investors feel about the market's future. This can sway investment values depending on trends and news. All these elements come together to shape the ups and downs of your investment portfolio. Linked to what affects a stock's value is another important principle, which is time in the market. Market volatility is part of the game. Investments go up and down daily. When we talk about time in the market, we're really talking about playing the long game with your investments. For the average investor, it's not about trying to be slick and trying to time when you can buy and sell investments to make the most money from it. Instead, it's about sticking with your investments over the years and letting the market do its thing. Markets can be a roller coaster ride in the short term, but they generally trend upwards over the long haul. By staying invested, you give your money the chance to grow through the good and the bad times, benefiting from the compounding effect where your earnings start earning money too. So the idea is simple. Keep calm and stay invested, letting time work its magic on your portfolio. Last but definitely not least, let's talk about the fact that investing is not a get-rich-quick scheme. Investing is sometimes mistaken for a get-rich-quick scheme, which sometimes lends people to fall prey to scams. In reality, investing is more about steady growth over time. Consider the stock market, specifically the S&P 500, which has had an annual average return of about 10% over the last 30 years. To illustrate the concept of steady investing, let's say you wanted to reach $1 million starting from zero. Based on these historical returns, let's just say you want to retire in 30 years, and let's say you're 30 years old right now. And you want to retire, you've currently got nothing in your investments, and you expect to earn the average 10% that we spoke about. You would need to invest approximately $442.50 in order to end up with $1 million in 30 years' time. Now, if you increased your investments to $500 a month, you'd end up with 1.1 million. And if you could increase your investments even more to $1,000 a month, you'd end up with 2.2 million. Now, let's say you wanted to retire a little bit earlier in 20 years' time rather than 30. That means you'd end up with 760,000 in your investment. These examples show that while investing can build substantial wealth, it requires patience and regular contributions and time for your money to grow through the power of compound interest. It's not instant, but it's a reliable way to work towards financial security. This has been a long video, but hopefully you found it useful as a whistle-stop tour of a beginner's guide to investing. It's good to have a mix of different investing methods, and at different points in your life, you'll probably apply a different mix of these. But I hope more than anything that after watching this video, if investing isn't something you've started doing yet, that this has sparked a curiosity and made you want to start on this journey. Thanks for watching, and see you in the next video.